So what we are going to do is we are going to open Yahoo Finance, and in that we will see search for Apple. So AAPL is the uh, code for Apple, and once you open Apple, you will see it is trading at $112 as of September 11th, and you can see this long run in the Apple stock. So the other thing is that is very important is the market cap. So you see the market cap for Apple is almost close to $2 trillion. So basically what market cap is the price of the share multiplied, which is like $112 multiplied with the number of shares outstanding. So how to find the numbers of shares outstanding? You have to go to statistics here and scroll down, and you can see here number of shares outstanding. So it will roughly give you the estimate of the market cap of the company. So what does market cap means is how much the whole company is selling for. So if you have $2 trillion today, you can buy the whole Apple company. Now what I'm going to show you is how to do a intrinsic value calculator for this stock. um, what we can see is, we have to see basically what intrinsic value is. Like, it's going to give you a value of the business, right? It's like the how much cash that can be produced from the business for, say, like 10 years, 12 years, etc. So what we are going to do it very simply is we are going to open Excel here for the calculation. We'll open a sheet, and then what we are going to do is we are going to go and see the cash flow statement of Apple. Why cash flow is important is you need to see like how much cash is coming out of the business, right? So that's the money that the owner gets basically. So for example, if you buy a place and put it on rent, so what you're going to get is like the rent that is going to come in, and then there will be a depreciation of that assets over time, and then on that you have to have some expenses on the rent, right? So you have to have some maintenance charges in order to maintain that building. So you subtract that maintenance charges and you will get a cash flow. And over time, good companies do is like they take that cash flow, reinvest in their company, and let the company grow, right? So I'll show you how to calculate the intrinsic value. So here you can see the net income for Apple for this quarter, like time frame, is around $58 billion. So this is like in thousands. So this turns out to be $58 billion. So let's see, we'll write net income, right? And of Apple. So that will be 58. So let me make it easier here. Let's see. Let's do a very basic calculation, right? So you have this thing. Then what you will see if you go back to the screen is this amount, depreciation and amortization. So that's basically what the plants and everything else that Apple has is getting basically depreciated over time, but that has some value, right? So there is some real estate value there, and if you own the whole company, you own the buildings too. So let's say approximately it's like 11 billion, and then you have, in order to sustain that business, right? So Apple has to invest some money to sustain the business. If they don't, then in 5 to 6 years the competitors are going to come in and take away the business, right? And that is captured in the capital expenditure section here. right? So that's a negative, right? Because it's an investment. It's not like cash that is coming out of the business. It's the cash that you need to maintain to sustain the business over time. So that's capex. So you can have, oh sorry, capex, and that's 8 billion. So according to Warren Buffett, what owner's earnings is basically you add the you basically add the net income with the depreciation and amortization and subtract the capex, right? Because that's the ultimate cash flow. So owner's earnings or cash flow, cash flow from the business. So what we will get is 58 plus 11 minus the capex. Sorry, so that's $61 billion. So let me add the billion here. And what's the, so I'll write the formula here. So that's net income. Basically, that's net income. Sorry. So owner's earnings equals net income plus DNA minus capex, and that this is true for any company that is available in the market, right? So if you have a big automotive company, the capex for them is usually very high in order to sustain their business because they have to buy the raw materials, keep the inventory, pay to their workers, and also maintain the facilities. If they don't, obviously, right? If they don't, like for example, Ford, if they don't do that, they cannot make cars after like a few months, and they go out of business. So this is very important. Subtracting capex is very important. That gives you the true value of the earnings. So let me write this: Apple stock intrinsic value. Now what we have to do is we have to dig some history of Apple, right? And see what rate this earnings is growing or not growing or whatever, right? So this is for 2020. So if I do 2019, I can go back to Yahoo Finance and check this. So you have 55 there, right? 55, and then your DNA is $12 billion, around 12, and the capex is 10, right? 10 billion. I'm doing an approximate calculation. Intrinsic value doesn't need to be exact. And if I do that, so you see there is like $57 billion. So it moved from 57 to 61 in 1 year. If I go back one more year, you will see that this is 59, almost 11, and this is 13. So I'll put that here: 59, 11, 13, right? And that will give you 57 again, right? So this way you can see all this. Now what you can check is you can check some analysis from what the Yahoo Finance already has, and they will have, if you scroll down here, for the next 5 years they are predicting Apple to grow at 12 and 12.46%, right? So that's a good number. So what we are going to do is we'll take this number, which is 61 billion, right? Years. We'll write here years, and we'll see here cash flow from the business, right? And what you can do is you can start with 61 billion. Sorry, so this is years 2020, right? 61 billion. 2021, there will be something. 2022, 2023, like this. And we can do it for 10 years, right? There is no point of, oh sorry, there is no point of doing it for like 20 25 years, because you see, the it's too far in the future, right? You have to do this calculation. You have to keep an eye on the business, and you have to do this calculation again and again over time. Now, the what's going to happen is, if we assume for the next 5 years the Apple is going to grow at this rate, 12%, let's say 12%. So that will be, you have to have this money here, right, multiplied with that. 12% means it became 1.12 times, right? So you saw how I did it, right? So you, and then that is for 5 years, right? So this number here into 1.12 times, right? Because it's 12%. So we can do the same for 5 years, right? So that gives us this cash flow for us. And beyond that, now that's the tricky part. Beyond that, we don't know whether Apple will continue growing at 12%, right? So we have to be very conservative. Otherwise, we can predict a huge number, and at the end of the day, what is going to happen is you will calculate an intrinsic value that is way higher than the real intrinsic value, and you end up paying too much for the stock, right? So what we are going to do is we are going to take this and we'll do an increase of 5%, right? So we'll do 1.05. Let's be conservative. For the 5 years from 2026, it's going to grow at 5%. Let's do that. Now the other thing, now the important part, right? Present value of the cash flow. Now you have to think like this, right? Like the money that is like $100 today is not the same as $100 from 2 years from now, right? Because there is inflation, prices are increasing, and you have to, and you have other things, right? You can invest that $100 for 10% a year, and at the end of 1 year you will have $110, right? So we have to discount this cash flow to the present value. And if we take a discount rate of 10%, which is a very good return in a 0% world, right? If you're expecting discount rate to be 10%, what we are going to do is we are going to divide this thing by 1.1, right? Power 1. Why 1? Because 1 is the year 1, right? So basically you divide it with 1 power 1, 1.1, 1.1, because our discount rate is 10%, right? And you have to do the same for the next one. You have to do the same 1.1. Now it will be power 2 because it's year 2, right? Or you can start with 0. So 0, 1, 2, whatever. It doesn't really matter. Now for the third one, see the value is going down now, right? So $76 billion from 3 years from now is not same as $76 billion as of today. So you have to do 3. See, it's coming down. It's almost close to $57 billion, right? So that's important to know. And this calculation is really important. That's why. 1.1 power, 4. So things like that. Let me see if Excel picks up the trend here. Otherwise, I have to do it manually for everything. Well, it didn't pick up. So I'll do a Control Z here and do it manually again. So this one divided by 1.1 power 1, 2, 3, 4, 5 now, right? You see, everything is coming down around 59. So on paper, $95 billion looks a lot, right? But the present value of $95 billion discounted at 10% per year is just $59 billion, right? So that's very important to know, which many people miss. And now you see the cash flow is going down, right? Because the Apple is not increasing at that rate, and we are discounting at a much, 5. I think we are in sixth year now. Let me count: one, two, three, 4, 5, 6. Oh, so this is 6. Sorry, this is wrong. This has to be 6, and this has to be 7. Seventh year. And then we have this 1.1 power 8. You can do it for 5 years too, but I like to see the full picture of like in 10 years, right? 1.1 power 9, and this will be this one divided by 1.1 power 10. Oh, sorry, 10. And this will be 1.1 power 11. Okay, so that's all the cash that Apple is going to produce in the next 10 years discounted to present value, right? And so as long as Apple is doing the same thing that they are doing today, right? Investing in new technologies and coming up with new iPhones, and they can maintain this growth rate, which is not very, I've not taken a very aggressive growth rate here, but that gives us a lot of safety with the stock. So Apple is going to produce this much basically cash flow over the 10-year period, right? So we can do the sum of this, sorry, sum. So sum, and that will be this to this, right? And here we can do, I need to write this as in $1 billion. So this is also in $1 billion. So that's interesting to look at, because now you know, if you own the business, Apple on a very conservative basis is going to produce this much cash, which is around $600 billion, right? 612 to be exact. In that, we have to add cash on hand, right? So when you buy the business, Apple will have some cash on hand. And where to find that? So you have to go to Yahoo Finance, go to the statistics sections, keep going down, and you will find this total cash for this quarter is $93 billion, right? This is the cash that they have as of today, right? That is yours. So you can write that 93 here, cash on hand. And what yes, so these are the two things that is there that Apple is going to do over the next 10 years. Now if you sum total, so you do sum total and $1 billion, right? And you do this one plus this one. So this is the value, right? Now at the end of 10 years, let's say you own Apple, right, as of today, and at the end of 10 years, you are going to sell the whole company, and let's say it is trading at 12 times or whatever, like 10 to 12 times this earning, right, which is of the 10th year, so which is basically $48 billion. Oh, sorry, the which is basically so what which is basically this, right? $137 billion. I'm not like doing the present value, right? So that will be, let's say, Apple after Apple in 2030 is trading at 10 times 2030 cash flow, right? So what's going to happen is we'll have this cash flow here into 10. So that's that, right? And we have to discount that, to the present value. So this number, as you see here, we used 11th here. So we'll use the same 11 here. So we'll do this divided by 1.1 times power 11, and the present value will be $480 billion. So intrinsic value basically of this whole business, holding it for 10 years, collecting all the cash for 10 years, and then selling it at 10 times the earnings of, or the cash flow of, the 10th year for Apple will be sum of all this. So you will have the sum total of this plus this. So you will have $705 billion plus $480 billion. So that's like, this is $1 billion, right? So it's almost 1.2 trillion, right? So that's the intrinsic value of Apple. Now, if we divide this with the shares outstanding, right, which I showed you. So shares outstanding is 17.1 billion, right? So this will be intrinsic value of Apple per share will be, because both are in billions, we can just divide this by 17.1, and billion and billion will cancel, and that's dollars per share. Very important number, right? That's the stock intrinsic value of the Apple stock. Now it's very easy. Now you go up and you check. Apple is trading at $112 per share. So it is, trading almost 2 times of its intrinsic value. And that's why you should not do the investment in Apple. I'm going to upload this Excel, you know, with the video so that you can follow along and see the formulas. I'll just touch it up a little bit so that it's much easier to follow. So it's very interesting that you can, based on the estimates that we got just from Yahoo Finance, we can actually calculate the intrinsic value of Apple. And then we saw that Apple is trading way above its intrinsic value. So we should not invest in Apple at these share prices. For some reason in the future, if the share prices drop due to a market correction or something, and at the same time the business fundamentals of Apple remains the same, if it drops way below 69, because you need a margin of safety on your calculation too, you can buy the stock at, say, like if it drops to $40 or something. Also, what can happen is over time Apple builds more and more money, right? And then the stock drops, but you have to do the calculation again at that time to find a new intrinsic value. And if the stock is trading, 20-30% discount of its intrinsic value, you can buy the stock. I hope you liked the video. Please like and subscribe. Thank you. See you in next time.